Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Jordan Roy-Byrne, founder and editor of The Daily Gold. Now, Jordan, look, let's face it, over the last week, really over the last kind of week and a half, markets have broadly moved sideways. Maybe they're consolidating some of these recent gains or that rebound. Maybe they're setting up for another fall. Only time will tell, and it depends also what side of the coin you lean on, and sometimes the biases that play into people's narratives. One thing that does seem very prevalent, though, still on everyone's mind, is the fact that potentially there is a big market correction, a crash, a capitulation move coming for the broad averages, and that could pull down the metals and the metal stocks. Jordan, what do you think the odds are of this happening probably next year?
Well, hey, Corey. I mean, the interesting thing now is I'm looking at some long-term charts. And the interesting thing now is if you're looking at whether you're looking at gold or the gold stocks, and even you could throw silver in there, although silver's been the strongest. Aside from silver, gold and gold stocks are basically coming up to, or they're very close to the 200-day moving average. The S&P has come up to the 200-day moving average. So we have seen some good things in precious metals. I like the way the monthly charts are really setting up. They do look different from the monthly chart of the S&P. But that being said, they have been following the market. And so we know that that's something that can't go on. Like for this to be a real bull market move in precious metals, that cannot continue. And so I think that fundamentally the divergence or kind of the way they should detach from each other is there's economic weakness and the Fed is forced to pivot completely and move towards cutting rates. That in that environment, you're going to see bond yields come down a lot more, and they'll accelerate to the downside. At the same time, you should see precious metals diverge from the stock market at that point. And I don't think we're at that point yet. So I think the concern that you could see a move lower in the stock market, whether it's January or the end of the first quarter, sometime in there when it looks like a recession is really starting to begin, because we're seeing a lot of warnings, but there's still some economic data that hasn't weakened enough, like unemployment, for example, although it's a lagging indicator. I do think when you see some of those things and, maybe the stock market starts to decline right before those things become obvious, in that scenario, you would see the gold stocks come down, but you wouldn't see gold come down as much. So like right now, we're seeing the stocks really outperform gold because the stock market has rallied. I mean, that kind of environment is more positive for the miners than gold. But when we get into an environment where everything can decline, gold's going to hold up best in that kind of environment. And eventually you move towards the point where the Fed has to pivot completely. And again, that's going to be bullish for precious metals and not the stock market. So I don't think so. I mean, long story short, I do think in the immediate sense, yes, there probably is some downside risk or some risk of this move in precious metals softening, but I don't see a 2008 or a 2020 scenario where the market is going to have this crash really, and it's going to bring everything down. One thing like leading into 2020 and 2008, the precious metals had performed really well. I mean, leading into 2020, gold had already been rising since the summer of 2018. And same thing, 2008, you had 7 years of precious metals doing really well. If we look what's happened now, precious metals have only been doing well for like a month or two. They're coming out of a severe cyclical bear market. So it's a completely different setup. I don't have this worry about, well, the market's going to come down and completely destroy precious metals like it did in 2008 and 2020. There's very little evidence that's going to happen. Maybe at the beginning of the move down in the market, it's possible that, you could see a little bit of downside in precious metals until that 180 from the Fed. But I don't see the setup like there was in 2008 and 2020. And I mean, there's a lot of similarities right now to the early 2000s. Like that, I think, when you were 8 or 12 months into that bear market, precious metals had bottomed. They had already started to diverge, and that was before. I mean, that was nearly a 3-year bear market. So there was a severe decline after precious metals had bottomed, but they weren't affected. So I am just seeing people I think are worrying about that a little too much right now.
Well, Jordan, another thing that has been a factor all year long in the markets has really been, up until the last couple months and really the last couple of weeks, the strength of the dollar, but also the continuing ratcheting higher of interest rates. You had some interesting thoughts off mic before we started recording about what you're seeing in the bond market and the interest rate markets. Are those going to continue to be headwinds against the precious metals as we move forward into next year, or what's your outlook on bonds and the dollar?
Yeah, I mean that's a really important question because the two have been moving together. We've probably seen sovereigns, selling needing dollars and they're selling bonds to get dollars. That's a really, really interesting question. I mean, I do think both of them have hit an important point. I mean, I could see the dollar rebounding and moving higher at some point next year, but I think just looking at the 10-year yield, I mean, I think it's possible it's possible. I'm not predicting it, but I think it's possible that it has put in a peak and that it could continue to decline to the downside. I know that it did this in June and July, and that faked people out, including me, but it got up to 425, and now it's down below the 50-day moving average, down below 380. I haven't checked it this morning, but I think that's something to watch because if it becomes apparent in the next couple weeks that the 10-year yield has put in a peak, I mean, that's a signal that the Fed is really, I mean, we know they're already really close to being done, but if the 10-year yield keeps falling and these curve inversions are going to get even more extreme, those are signals that basically warning you that the Fed is about to stop hiking rates. So I think watching interest rates and yields in particular is really, really significant. I mean, that's definitely an indicator we need to watch. Also, the dollar at the same time, because maybe you see yields come down, but the dollar doesn't come down as much, and that relationship breaks a little bit. I don't know the answer, but I'm just saying that could be the start of a real change in the regime that we've seen. If we see the 10-year yield and long-term yields start to come down and accelerate to the downside, and at the same time, maybe that breaks from the recent relationship with the dollar. I don't know. I'm just putting it out there as an interesting development.
Jordan, what if we're in a different world now where rates more or less just move sideways at this generally higher level than we have seen compared to the last few years, and especially considering rates pretty much fell for the last multiple decades, and that was the trend? What if the new trend is sideways rates?
Well, I mean, it's possible, and it depends how much lower the 10-year yield and the 2-year yield are going to go. Because, I mean, if you look at the 2-year yield, the 2-year yield's at 4.47. I mean, it's possible they could move sideways for the next year or two, but we're at the beginning of a point where they could move down. Even in the 70s, you had some legs down in interest rates. I mean, they had huge moves higher, but I think you could think that the primary trend for yields is higher, and that yields will go, they'll continue to trend higher over the next 5 to 7 years. But even in that scenario, you can have a recession and yields could come down at least a couple points. So I just don't see it as likely that yields have peaked, but they're going to kind of go sideways here without coming down much, especially when you look at inflation expectations. I mean, if you look at oil starting to break down, break evens, I've seen a chart of those where they look like there's risk they could come down significantly. So I don't think they're going to be able to go sideways. I see them coming down more, but I do think it's possible that, they're not going to fall down and like crash lower, like we've seen at various points in the last 5, 10, 15 years.
Well, Jordan, real quick, we're getting ready to head into the holiday season. This is kind of when tax loss selling typically starts off, as post Thanksgiving weekend and then heading into December. When you look at GDX, GDXJ, and we've had a nice bounce just over the last, let's say, 2 months, Are you concerned there's further downside pressure here for the month of December coming up, or is it maybe not going to be as extreme as some are expecting?
Well, I think the tax loss selling is you have to look at individual juniors. Looking at GDX and GDXJ, I think a bottom is in. If you look at a comparison to 2018, they put in a bottom. They had a decent rally, and then they kind of went sideways or went lower for a little while until the Fed did its last hike. So I could definitely see a repeat of that. As far as GDX and GDXJ, I'm not worried that they're gonna lose the lows that they put in. I mean, I think if they give back some of these gains, that's not going to worry me because looking at the monthly charts, I think the low is in. I think that aligns with the macro fundamental viewpoint that the Fed is that they're about to pretty soon they're going to stop hiking. And at the same time, if you look at a chart of the real 10-year yield, which I was looking at yesterday, it kind of looks like it's put in a peak, like maybe a little double top. So I mean that's struggled to move higher in the last month or two, I want to say. So I just think when you look at all these things, you got to be bullish on precious metals and not be swayed by, if they just correct here because they hit the 200-day moving average or because people want to sell in December or because you think the stock market's going to crash. I mean, none of those reasons dissuade me at this point in time. But I do think looking at individual juniors, some of those have already been victimized by tax loss selling and that those could set up pretty nicely into January in the first quarter.
All right, Jordan, we'll wrap it up here. Boy, oh boy, we'll see what next year brings. This year, big picture, gold's still flat. A lot of the stocks, though, have taken it on the chin, but that's pretty much every sector out there, maybe outside of energy, but now energy's showing weakness. So overall, hopefully next year's a bit of a better environment, really for all investors, and especially precious metals for all of our listeners focused on that sector. Jordan, thank you as always for your time. We'll chat next week. I hope you have a very happy Thanksgiving.